There is an undeniable psychological draw to getting paid 12 times a year. A monthly dividend aligns with your household budget, matching the electric bill and the mortgage, and it makes passive income feel tangible by accelerating the cycle of reinvestment. But social media is filled with the promise that you can take a small portfolio, say $100,000, and easily extract $1,000 of passive income every month just by hunting for stocks that yield 12 to 20%. Slicing a pie into 12 pieces instead of 4 does not give you more pie. The frequency of a payout, monthly versus quarterly, has no impact on the underlying economics or the quality of the business making the payment. When you see a massive double-digit yield, you are looking at a warning sign. Wall Street discounts these stocks because the market anticipates a dividend cut or a rapid erosion of your principal capital. This is a yield trap. This quadrant chart maps the reality of dividend stocks today. On the vertical axis, we have the initial dividend yield. On the horizontal axis, we have the future dividend growth rate. We can plot companies like AGNC, Realty Income, and Visa to compare exactly what they pay today against their potential to grow tomorrow. Look at the extreme ends of this chart. If you buy a stock like AGNC yielding 14% today, you are accepting that your payout will likely never grow. On the exact opposite end, Visa pays almost nothing upfront, but increases its dividend every year. You are forced to make a strategic choice. You must choose between extracting a high volume of immediate cash flow today and the long-term wealth compounding that builds over the next decade. This comparison matrix breaks down a systematic framework for evaluating dividend assets, weighing their initial yield against their structural trade-offs. The first category is the high-yield monthly universe. This includes mortgage REITs like AGNC or Orchid Island Capital. These companies do not own physical real estate. They rely on heavy short-term leverage to purchase low-yielding government mortgage bonds, profiting from the spread between the two interest rates. The structural flaw here is significant. When short-term interest rates rise, borrowing costs spike. That profit spread can disappear, leading to dividend cuts and capital erosion. The second category is synthetic monthly yields, specifically preferred call ETFs like JEPI or QYLD. These funds deliver defensive, high-frequency income, but the trade-off is clear. You surrender your upside growth potential during bull markets while facing less favorable tax distributions. Relying on these high-yield monthly assets requires a conscious sacrifice. You trade away your principal's growth potential to generate immediate cash. Category 3 is the safe monthly core. This includes blue-chip net lease REITs and quality business development companies like Realty Income and Main Street Capital. Backed by physical real estate or diversified loans, these assets provide a reliable baseline of cash flow. In exchange for that predictability, you trade away capital appreciation. This brings us to the exact opposite strategy, the dividend growth engine. From 2008 to 2010, Verizon starts with a 5.6% yield, while Visa pays just 0.2%. Tracking yield on cost across 12 years, the lines cross. Visa's payout reaches 12%, overtaking the high-yield incumbent. Dividend growers operate with lower leverage, lower payout ratios, and higher free cash flow growth. By keeping payout ratios low, they reduce the risk of a dividend cut, retaining cash to survive recessions while still raising payouts. This bar chart shows the impact of those different structures. Over 16 years, Visa's 21.45% total return was more than triple Verizon's 6.44%. Pursuing a high initial payout often leads to a lower ultimate return. Even when starting from a yield of less than 1%, the compounding power of a fast-growing dividend can generate more total wealth than an established high-yield stock over a 10-year window. You cannot have maximum yield, maximum safety, and maximum growth simultaneously. A compromise is mandatory. This decision tree maps out your strategy based on one critical question. Do you need this income to pay living expenses today? If the answer is yes, you are on the retiree path. You should prioritize safety over yield by blending blue-chip REITs, quality BDCs, and defensive covered call ETFs. You secure the cash flow, accepting that your principal will not grow quickly. If the answer is no, and you have a 10-year time horizon, you are the accumulator. Avoid high-yield traps and focus on quarterly dividend growth stocks for total return. For hybrid investors, there is the barbell strategy. Build a 60% foundation of quarterly growers for inflation protection. balanced by a 40% sleeve of reliable monthly payers for cash flow smoothing. Your choice depends on your required capital. Generating $1,000 a month at a safe 5% yield requires $240,000. Generating that same $1,000 at a 12% yield only requires $100,000. But if a lack of capital is forcing you to chase that 12% yield to make the math work, you are taking on massive structural market risks that you likely cannot afford. Business quality and your personal time horizon must dictate your strategy. Never let the frequency of a check determine the quality of your investment.